Hi, and welcome to this week's look at the major news stories impacting the markets so far. Well, today we're going to cover a couple of different topics. We're going to take a look firstly at European currencies, and they're at pretty much strategic levels against the US dollar at the moment, and obviously the dollar being quite weak lately. We're also going to take a look at how US stock markets reacted to the GDP news that came out just this week. Thirdly, and fourthly, we're actually going to look at a couple of commodities, and we're going to talk about the OPEC Plus meeting and potential impacts on the price of oil. And we'll finally sign off with a little bit of talk about the price of natural gas. Obviously, winter in the Northern Hemisphere, and that playing on a lot of people's minds. So let's start with European currencies being at strategic levels and what they're doing against the US dollar. Well, the downward trend in the US dollar certainly seems to be continuing. Wednesday, we saw the euro dollar test the important resistance level at 1.100. We also saw the pound against the dollar. That strengthened to 1.2700. And to add a little bit of North America into the mix, US dollar against the Canadian dollar fell below 1.3600, all on Wednesday. Now, data coming out Thursday and in the coming days could well shape the next moves. So we'll look at each one individually. Let's take a look at sterling against the dollar, or cable as it's known colloquially. Third week in a row for growth in the price. Pretty good, pretty impressive from a sterling perspective. Wednesday, as I've mentioned, we saw 1.2700 breached, but as yet, no real consolidation above this level. In fact, take a look at the chart. It's a reversal bar formed at 1.2660. Now, if that's really tested, we could see a move down towards the 1.26 to 1.25 range. However, a move above Wednesday's high of 1.2730 could also see us test the psychological level of 1.3, the figure. Nobody quite sure which way it's going to go. There is some data coming out of the UK and the US on Thursday. Keep your eyes on that. Take a look at the euro against the dollar. Well, that Wednesday tested support at 1.100. Again, no consolidation quite as yet. Now, if the pullback that we saw off of that is not deep, we could see an attempt to approach 1.1020 to 1.11, the figure. Be quite a bold move. If the reversal bar that's formed at 1.0960 is properly processed, well, then it may decline to the nearest alligator line on that daily time frame. In terms of the euro against the dollar, we've got German unemployment data, Eurozone CPI, and a speech from Christine Lagarde, all on Thursday PM evening. So do keep your eyes and ears open for that. Finally, a quick look at the dollar against the Canadian dollar. Well, commodity currencies have been in a bit of a consolidation phase this week, as we've seen a pretty narrow range the last few days of 1.3660 to 1.3540. Well, there's lots of data coming out of the States and Canada to Thursday and over the next sort of 5 or 6 days, which could well spark volatility. So as ever, don't forget your risk management techniques. We've got US price index of personal consumption expenditures for October, and we've also got unemployment benefit applications, obviously a good measure of health of the workplace. From Canada, we've got the GDP figures and average weekly income figures to come. So again, I'll repeat it, we could well see a spike in volatility. So don't forget those risk management techniques. Okay, now time to take a look at how the US markets reacted to the US GDP figures. Well, data released on Wednesday show that the US economy is growing at a stronger pace than expected. So the third quarter GDP figure came in at 5.3% for the year against an expectation of 4.9%. Now, this twinned with the Fed's softening rhetoric is a positive sign for the US stock markets. So far in November, we have seen the S&P 500 increase 8.5% and the Nasdaq Composite up 11%. That's the best month since July 2022. In fact, Wednesday we saw the S&P rise close to the high of the year. However, the chart shows signs that the November rally may not continue into December. Well, why is that? Well, November's progress was mainly in the first half of the month. Second half growth has slowed, as evidenced by the change in angle of the purple channel relative to the blue channel. You can see that there quite clearly. So, real strong start to the month, tapering off a little bit as we get into the back end. Also seeing the level of 45.75 is becoming effective resistance. Now, Wednesday's top then saw sellers rather sharply drive the price lower, thus forming a false breakout of that 45.75 level. But let's note a couple of things here. The upward trend has not been formally broken, and the market may well try and find support from the median line from the ascending channel and try and revisit and set a new high for the year. Now, it does seem that the positive news and factors are already factored into the current price. So any negative factors that pop up may well lead to a further correction. Again, this is where geopolitical concerns can well come in. It's also worth noting that JP Morgan analysts have forecast the price of the S&P 500 to fall to 4,200 next year amid what they call a challenging macroeconomic backdrop. So as ever, things are far from clear, but certainly a good month November so far. We're still in November as of this moment, and lots of things to keep your eyes and ears open for. Okay, commodity time, and Thursday the 30th of November, OPEC Plus countries are meeting, and they may well announce new oil production cuts. So the meeting, Thursday the 30th, has actually been rolled over or postponed from before, and a lot of people saying that's talk that some members of OPEC Plus aren't actually that comfortable with further cuts or even the existing cuts to production. They want to produce more. Now, according to the Wall Street Journal, what's being put forward at this meeting potentially could be a reduction of up to 1 million barrels per day. Now, in anticipation of that decision, we are seeing a rising oil price. Market participants clearly believe the risk of cuts in production is very, very real. Even if it's not as much as 1 million barrels per day, the price is rising towards November highs. If we take a look at the Brent crude chart, that shows us that $80 per barrel has acted as support previously. In fact, we bounced from that level quite a few times over the last couple of years. Rising lows, A, B and C, indicate a predominance of demand at that psychological level. And the price has been in a descending channel, which we're showing in red, for more than a month, but it's trying to consolidate above that median line. And now that is a sign of bullish persistence. However, if OPEC Plus fail to reach a consensus at this meeting on production cuts, and in fact significant production cuts, the bullish sentiment could easily change. This could be a driver for the next couple of months price-wise for oil, and is really quite an important meeting. And as I say, postponed once, and talk of disagreement, shall we say, between some of the larger and smaller members of the OPEC Plus. So keep your eyes on the news. We will probably hear something later on Thursday. Okay, finally, and sticking with commodities, we're going to take a look at the natural gas price, and that's fallen to over a 2-month low currently. Now, natural gas, obviously this time of year, particularly in the UK, where we seem to be experiencing the first real cold snap of winter, has a direct impact on people's consumers' pockets. Well, Monday, natural gas price dropped below $2.900 for the first time since mid-September. The US natural gas weather forecast changed last weekend. Previously, they've been talking about a cold snap into December. That has been changed to warming for December, thus the demand could fall, which obviously would be a main driver for the price to fall as it has done. Now, according to analyst forecasts on Monday, natural gas reserves at the end of winter could be 2 trillion cubic feet. Now, that's against a previous forecast of 1.9 trillion cubic feet. And they're also saying the price could be $2.75 against their previous forecast of $3 or slightly less. Would appear to be good news for the average consumer. Now, the chart shows that the price is near the lower border of the channel in blue, which can provide support. And also the MACD indicator shows signs of divergence. Now, that is a sign of weakening selling pressure. Now, thus, although the market has been bearish and in a bearish trend since the beginning of November, which we're showing in red, the chart is definitely showing us some bullish signs, and the price may well rise in the short term to the upper limit of that red channel. This scenario, of course, could well be increased if the weather forecasting model shows a return of a cold snap. Obviously, weather-dependent pricing here, and it's something that we all feel in our back pockets, and all consumers will feel, and major commercial corporations and organisations as well. Weather forecasts, keep your eye on them, have a look at see if you can see in as far forward as you possibly can. Obviously, everybody would tell you that forecasting models not necessarily as accurate the further they go out, but interesting perhaps in your analysis to start including weather forecasts. Don't forget your risk management techniques, and we wish you luck in the week ahead. Bye for now.